Your bank sees you as one of two things: a problem to be charged or a relationship to be protected. Which one are you? To find out, we sent two people, one with almost nothing and one with millions, into the same bank to make the exact same requests. What happened next exposes the hidden and, frankly, disturbing rules of our financial system. Let me tell you something your bank will never say out loud. They don't treat you based on who you are. They don't care if you're a good person, a hard worker, or a pillar of your community. They treat you based on one thing: the balance in your account. To the bank, you aren't a person. You are a data point, a risk profile, a profit center. And depending on which side of the zero you fall on, you will experience two entirely parallel worlds existing inside the exact same building. So today we're pulling back the curtain on this financial divide. We've enlisted two individuals to be our guides into these separate realities. Meet Adam. Adam's a freelance graphic designer, a classic gig economy soldier. His income has its ups and downs, and after a few tough months and some surprise medical bills, his checking account is sitting at a precarious $150. His net worth is pretty much zero. He represents the millions of Americans who are just one emergency away from disaster. For him, a bank is a place of anxiety, a source of stress, where every interaction feels like a trap. He feels like he's constantly being watched, one mistake away from a flood of fees. Now, meet David. David's a successful entrepreneur who sold his tech startup a few years back. His bank account? It holds just over $5 million. He represents the top 1%. For David, a bank isn't a place of fear. It's a tool. It's a partner. It's a concierge service designed to make his life easier and his wealth grow. He doesn't wait in lines. He doesn't worry about fees. The bank works for him. Our mission is simple. Adam and David will walk into the same branch of a major national bank on the same day. They will make three identical requests. First, they'll each ask for a small unsecured personal loan. Second, they'll try to get a common bank fee waived. And third, they'll test the bank's customer service. The results aren't just different. They reveal a system that is methodically, mathematically, and psychologically designed to keep the rich rich and the poor paying for the privilege. What you're about to see will change the way you look at your own bank forever. The first experiment: the personal loan. Our first test is designed to probe the very core of a bank's function: lending money. Both Adam and David will request a simple, unsecured personal loan for $5,000. For Adam, this money would be a lifeline, a way to fix his car and build a small cash buffer. For David, it's pocket change, but the request is the same. First, Adam walks in. The familiar sterile lobby does nothing to calm his nerves. He waits in the teller line for about 10 minutes, gets called up, and explains he'd like to inquire about a small personal loan. The teller, polite but impersonal, doesn't invite him to an office. She just hands him a brochure and points to a tablet kiosk in the corner. "You can fill out the application here," she says. "It'll let you know if you're pre-qualified." Adam sits down. The application is a digital interrogation: Social Security number, annual income. He hesitates, then enters his best-case scenario projection, around $35,000. It asks for his employer. He types freelance. It asks for his debt-to-income ratio. He does some quick, stressful mental math. Between student loans and a small credit card balance, it's not great. After 15 minutes of tapping on the screen, he hits submit. The loading icon spins for what feels like an eternity. Then, the verdict in cold, sans serif font: "We're sorry, but we are unable to approve your loan application at this time." No reason, no person to talk to, just a digital rejection. He feels a hot flush of shame and frustration. He was just judged by an algorithm and found wanting. To the bank, his fluctuating income and lack of assets made him a high-risk applicant. The system did exactly what it was designed to do: identify him not as a person needing help, but as a liability to be avoided. And he's not alone. About 15.7% of U.S. households have no access to mainstream credit, often for very similar reasons. He walks out of the bank feeling smaller than when he walked in. An hour later, David arrives. He doesn't wait in line. He walks straight to the wealth management sign, where a receptionist greets him by name. "Mr. David, good to see you. Let me get Sarah for you." A moment later, the branch manager, Sarah, comes out, hand extended with a warm smile. "David, so good to see you. Come on in. Coffee? Water?" David sits in a comfy chair in a private wood-paneled office. There's no kiosk here, just a conversation. "So, what can we do for you today?" Sarah asks. David keeps it casual. "You know, I was thinking of doing some upgrades to the lake house and was considering a small personal loan, just to keep my main investment portfolio untouched. Something simple, say $5,000. Sarah doesn't flinch. She doesn't ask about his income or his debt. She doesn't need to. She has his entire financial profile on her screen, a glowing testament to his low-risk, high-value status. The 5 C's of credit, character, capacity, capital, collateral, and conditions, are all screamingly in his favor. His capacity is enormous, his capital is in the millions, and his character in the bank's eyes is flawless because he has so much money with them. "Of course," she says, tapping a few keys. "That's absolutely no problem. We can have that approved for you this afternoon. Looking at your profile, we can offer you our preferred rate. Let's call it 5.9% APR. Does that work for you?" That rate is fantastic, well below the average for even excellent credit borrowers, which hovers over 12%. David agrees. The entire process takes less than 10 minutes. He hasn't filled out a single form. He's been approved for the exact same loan that Adam was algorithmically denied for, at a preferential rate, simply because the number in his account is bigger. For high earners, lenders are often comfortable extending larger amounts at premium terms because their high income means a low debt-to-income ratio. Sarah even pivots to a sales pitch. "By the way, have you seen the new opportunities in the private equity fund we just opened up to select clients? I think you'd be very interested." He walks out of the bank not just with a loan, but with a reinforced sense of status. The bank isn't just a place that holds his money, it's a partner actively helping him grow it. So what just happened? We just witnessed the 5 C's of credit playing out in real time. Banks use this framework to assess risk. Adam, with his fluctuating income, had low capacity. His ability to repay looked questionable to the bank. He had no capital, savings or investments, and no collateral to secure the loan. For the bank's algorithm, he was all risk and no reward. For low-income applicants, loan rejection rates can be 1.5 to 2 times higher than for affluent applicants, even after controlling for credit scores. David was the polar opposite. His capacity was nearly infinite. His capital was in the millions, acting as a kind of psychological collateral. Even for an unsecured loan, the bank knows he has the funds, and the conditions were perfect, a tiny loan for a high-value client. But the most important C was character. In banking, character isn't a measure of your soul. It's a measure of your financial history, and more importantly, your value to the bank. David is a valued player. Adam is a potential problem. This system isn't emotional. It's purely mathematical. David's approval was a rubber stamp. He was offered a loan at a great rate because the bank isn't really taking a risk. It's cementing a relationship with a client who makes them far more money in wealth management fees than they'll ever make from his loan interest. The second experiment, waiving a fee. Our second test is smaller, but maybe more revealing. It's about a simple fee. Now, you've probably heard that many banks have reduced or changed their overdraft policies, but these fees still generate billions in revenue. Adam, who recently had a transaction clear before a deposit landed, was hit with a $35 overdraft fee. David's account, of course, has never been overdrawn, but for our experiment, we've arranged for a hypothetical monthly maintenance fee to be applied so he has something to question. Adam's turn. This time, he calls the customer service number on his debit card. After navigating a maze of automated menus, press 1 for balances and press 8 for all other inquiries, he finally gets in the queue to speak to a person. He waits on hold for 22 minutes, listening to a repetitive loop of corporate pop music. Finally, a voice. "Thank you for calling. My name is Brenda. How can I help you?" Adam explains his situation. "Hi, Brenda. I noticed a $35 overdraft fee on my account. I had a deposit coming in the same day. It was just a timing issue. Is there any way to get that waived as a one-time courtesy? Brenda's tone is flat, scripted. He can hear her typing. I see the fee, sir. Let me check the notes. A pause. Sir, I see you also had an overdraft fee waived about 18 months ago. Our policy only allows for one courtesy waiver every 24 months for your account type. Adam pushes politely. I understand, but I'm a longtime customer, and this puts me in a really tough spot. Is there a manager I could speak with? Another pause. The manager will tell you the same thing, sir. The policy is automated based on your account profile. I can't override it. The fee stands. The call ends. The bank's policy, enforced by an algorithm and a call center script, is rigid. For Adam's account tier, fees are a profit center. He's not a relationship to be managed. He's a balance sheet entry, and that fee is part of the bank's revenue model. For Adam, that $35 is a painful loss. Now David. David doesn't call a 1-800 number. He calls Sarah, his private banker, on her direct office line. She answers on the second ring. Sarah speaking. Hi, Sarah, it's David. Her tone immediately warms. David, always a pleasure. What's on your mind? Just a tiny thing, David says. I noticed a $50 account maintenance fee on my latest statement. I thought my account tier wasn't supposed to have those. Sarah doesn't need to look it up. She knows his account shouldn't have fees. It's likely a system error, but her response is instant and aimed at total client satisfaction. Oh, I'm so sorry about that, David. That is absolutely our mistake. Let me remove that for you right now. He hears a few clicks. There, it's gone, and I've credited back an extra $50 for the inconvenience. Please accept my apologies. That should never have happened. No policy quoted, no hold time, no argument. The fee was waived instantly, and he was compensated for the trouble. For the bank, a $50 fee is utterly irrelevant compared to the value of keeping a multi-million-dollar client happy. This is a core perk of private banking. Dedicated representatives and fee waivers are standard. The contrast is stark, and it gets to the heart of the two different business models operating inside the same bank. For Adam's broke tier, the bank operates on a high-volume, low-margin model where fee income is crucial. The system is designed to be rigid and automated because it's cheaper than paying a human to make decisions. The bank is willing to lose a customer like Adam over a $35 fee because, in their cold calculation, his value as a client is less than the revenue from the fee. He is, in the language of the system, a problem to be charged. For David's rich tier, the model is completely different. It's low volume, high touch, and relationship-based. The bank makes its money not from fees, but from managing David's wealth, offering him loans, and selling him investment products. A $50 fee isn't just $50. It's a potential irritant that could jeopardize a multi-million-dollar relationship. Sarah's job isn't to enforce policy. Her job is to keep David happy. He is a relationship to be protected. Waiving the fee isn't a courtesy. It's a strategic business decision. The bank isn't just a mirror reflecting your financial position. It's an amplifier. For the wealthy, it amplifies their advantages. For the poor, it amplifies their disadvantages. The final experiment, customer service. The final test is about access and attention. How does the bank value the time of a poor person versus a rich person? Adam needs to ask a simple question about setting up international wire transfers for a potential client abroad. David will ask the exact same question. Adam starts with the bank's online chat feature. He's greeted by a chatbot. He types his question. The bot gives him a generic link to the wire transfer FAQ page, which doesn't answer his specific question. He types, "Speak to a human." The bot replies, "All our agents are currently busy. Your estimated wait time is 15 minutes. He waits. 20 minutes later, an agent connects. He retypes his question. The agent takes 3 minutes to respond, then asks for his account number and multiple security verification questions. Finally, they provide a partial answer but seem unsure about the specifics for his account type. The whole process to get a simple answer takes over 30 minutes and leaves him feeling uncertain. Now, David's turn. He has the same question. He sends a one-sentence text to Sarah's work cell. "Hi, Sarah, quick question. What's the best way to handle incoming international wires? Any limits I should know about? Less than 5 minutes later, his phone rings. It's Sarah. Hi, David, saw your text. It's very simple. For your account, there are no incoming limits. Just give the sender these routing and account numbers. I've just emailed them to you so you have them handy. If the client has any trouble on their end, you can have their bank contact me directly, and I'll sort it out. Anything else I can do? The interaction takes less than 5 minutes. He got a full answer, proactive help, and a personal offer to solve any future problems. This is the definition of white glove, concierge service. His time was treated as valuable. Adam's was treated as expendable. So, what have we learned? Adam and David walked into the same bank, governed by the same federal regulations, yet they stepped into two different dimensions. Adam entered a world of automated denials, rigid policies, long waits, and impersonal service. He was treated as a risk and a source of fee revenue. His experience was defined by friction and frustration. This is the reality for a huge portion of the population. In 2023, 4.2% of U.S. households, about 5.6 million families, were completely unbanked, often because they felt they didn't have enough money to meet minimum balances or bank fees were too high. For them, the system is a wall. David entered a world of instant approvals, flexible policies, and personalized immediate service. He was treated as a valued partner. His experience was defined by ease, access, and privilege. For him, the system is a well-oiled machine, a tool designed to serve his every need. He gets access to dedicated advisors, preferential loan rates, and exclusive investment opportunities that simply aren't available to the average person. Here's the most shocking part. Summarized. Requested Adam's result. Broke David's result. Rich. $5,000 loan. Instantly denied by an algorithm. Instantly approved by a person at a low rate. Fee waiver. Denied by policy after a long wait. Instantly waived with an apology and extra credit. Customer service 30-plus minute wait for an incomplete answer from a chatbot. A direct call back from a private banker with a full solution in less than 5 minutes. It's the same bank, the same rules, but a completely different reality. The only border separating them is net worth. This experiment reveals a fundamental truth about our financial system. The bank isn't your friend or your enemy. It is a mirror. But it's a funhouse mirror. It exaggerates what it sees. It exaggerates wealth with perks and access, and it exaggerates poverty with fees and barriers. The system isn't necessarily evil. It's just mathematical. It is built on a foundation of risk and reward. David is all reward. Adam is all risk, and the service level adjusts accordingly. But understanding this system is the first step to navigating it. It's about knowing the rules of the game you're forced to play. It means focusing on building your credit, creating a cash buffer, and understanding that when you have very little, the bank is not your partner. It is a service you must manage carefully to avoid its traps. This isn't just a story about a bank. It's a story about the power of money to shape reality. What's your experience? Have you ever felt the difference in how you were treated based on your balance? Share your story in the comments below. Your experience is part of this larger story, and it deserves to be heard. If this experiment opened your eyes, subscribe for more deep dives into the systems that control our world. The more we understand these hidden rules, the more power we have to change our own financial destiny.